So we got to talk about SoFi stock here today. It's been going up like crazy in the last few days. So we're going to talk about what exactly happened. Should you care? Why is it so important to SoFi? Is this a good time to invest, basically? But on the flip side, we're also going to look at obviously some of the risks that come with it and to consider with SoFi stock. Because at this channel, obviously, although we like SoFi, we like the stock, we're trying to be as neutral as possible. We're trying to weigh up the risk and rewards always. So let's go back straight into it. So if you are lucky enough to snatch up some of the shares in SoFi in the last few days at around the $12, you're looking at up to 34% gain in the past couple of days. So what exactly happened? So basically, there was a press release released by SoFi a few days ago, and I'm gonna read through that with you guys, take you through it. So SoFi announced today that the Office of the Controller of the Currency and the Federal Reserve have approved its application to become a bank holding company through its proposed acquisition of Golden Pacific Bancorp and operate its bank subsidiary as SoFi Bank National Association. So pretty much what SoFi stockholders and what SoFi management was really looking forward to or working towards to is getting that national bank charter. So now they will be able to operate as a national bank within the US, which brings a lot of benefits that we're going to talk through later about with it. So the CEO says, this incredible milestone elevates our ability to help even more people get their money right and realize their ambitions. Of course, he has to say something like that. With the national bank charter, not only will we be able to lend at even more competitive interest rates and provide our members with high yielding interest in checking and savings, it will also enhance our financial products and services to ensure they efficiently meet the needs of our members. So why does that increase the ability to lend money at a more competitive rate? So if you get that national bank charter, you can actually operate as a bank and you don't have to loan the money from someone else. You can actually loan your own money to your own assets to other people or other companies at a much lower rate. So you suddenly have the ability to raise funds from the funds that you receive from customers, because that's what banks do, right? They get money from customers and from other institutions, sort of at a cheap rate as well, like when they get it from the money markets, and they lend it out to you again at a higher rate. And the arbitrage between the interest charged to them and the interest that they charge to the customers, that's how a bank mostly makes money. So if you think about a bank, the interest expense that they pay on that loan is basically their cost of sales. So as soon as that goes down, their margin increased significantly. So this is why it was so important for SoFi to actually get that bank charter, to be able to increase their margin. And then, if you have that margin playroom and you have more of that, you can actually spend more on sort of customer acquisition, for instance, get even more people in. You can extend your products. And we're going to look at the numbers in a second. What I wanted to point out from this article, especially, is one important aspect, and that is that SoFi plans to contribute 750 million in capital and pursue its national digital business plan while maintaining the Golden Pacific Bank. So basically, for them to operate, so this acquisition is going to happen in February next month, basically, and that Golden Pacific Bank is going to turn into that SoFi Bank National Association. But the original SoFi company is actually going to contribute 750 million in capital, meaning that expect their debt to go up by 750 million. And that is sort of one of my key concerns when looking at SoFi. But we're going to look at that in a second. Other than that, there's nothing important here. So basically, that was the news that pushed that stock higher. Which is obviously, congratulations to all the shareholders. I also personally have a long position in SoFi, so I was happy to see that. But if you actually scroll out a little bit from a monthly perspective, we're still up, okay. Um, if you scroll a little bit further, obviously SoFi was tracked in that whole macro fear that for high growth and sort of loss-making companies or high growth and young companies that basically interest rate fears have pushed prices down because of the just the way the valuations work and the discounted cash flow. So interest rate hike fears, which interest rates haven't even increased yet, just the fear based on announcement that it might potentially increase have already pushed that stock down from as much as it was around $23. So it's been pushing down almost 48% since November 21 on their highs. And if we scroll out a little bit further, then you can see that basically what happened in the past year, it was always hovering around that 15, 16 range. And then whenever they announced that the bank charter is coming, it had this huge spike of anticipation by the market based on that news. Basically, buy the news or buy the rumor, sell the news kind of thing. Because once that news was kind of gone for a few days, it trickled down again to the 15, 16 range. Then again, bank charter coming, 23, now back down to as much as $12. So if you think about it, if we were just a little few months back, like let's say in October, September, these type of news that the bank charter is finally here everyone would have expected that the stock would have been pushed to, $25 to $30 based on those types of price movements back then. And now the stock is barely there or barely back up there where it used to hover around for the past whole year. So from a big picture perspective, if you've been long-term investor or longer-term investor in SoFi, as they're only listed in last year, but if you've basically been there for around the $15 to $16, you're barely broke even on that news. So that's just the type of new environment that we're in. That these type of news just bring it back to a level that you would have thought is a good entry point, anyways. But yeah, so what I wanted to point out, or let's go through why is that such a big deal. So when we look at it from a numbers perspective, right? So we've got this presentation here that I've got from a Seeking Alpha article, but it's actually from a SoFi investor presentation. And they were forecasting the EBITDA. EBITDA means earnings before tax, depreciation, and amortization. So they were forecasting that for the upcoming years, basically in 2021, saying, based on our growth rates, both based on our projections, this is what we can deliver as a profit margin in the upcoming years, which the dark blue or the dark violet here is without that bank charter. So even without the bank charter, we had a reasonable margins expanding 100%, 100%, and then a little over whatever it is, 50%. Even that would have been great as such. But just look at the potential impact that bank charter has and the ability to lend money at a much cheaper rate, get money at a cheaper rate. Just because of that margin improvement, we're basically making almost double the EBITDA in this year alone, which, if you think about it, just whatever your projections were, let's say the market price already priced it in a little bit, but now we have that full confirmation. So going forward, we can price all these increases fully into the stock, value calculation and the DCF and the discounted cash flow model. So basically all the numbers improve that we're putting in. Before we put in basically at 300, 500, 800, and now we're putting in 500, 700, 1000. So you can see how this massively changes the whole story of the stock. And this is why so many people are so excited about. So even this year we have $447, and that just keeps increasing, and basically on top of that initial projected EBITDA margin going forward. So we can definitely see that we've just made the stock a lot cheaper. So even if you thought that back then, a year back, anything from $14 to $16 was a good buy, then basically now you're saying it's an excellent buy because they just increased the EBITDA margin by almost double. So which is fantastic, right? So this is what you want to see. And I think it's really important if you have stocks like SoFi, right? It's like there's a story behind it, there's a vision behind it, that it's gonna be that one-stop bank for millennial and Gen Z. And if you see that kind of playing out, so management has been, promising we're gonna have a bank charter, we're gonna do this, we're gonna do that. And if you keep seeing them executing that way, and now they've promised an early 2021 2022 bank charter, and now we've got that approval pretty much in the first month of the year, which is fantastic. So that basically shows me also that management is executing. They're not just like, bullshitting us. Yeah, it's fantastic. And obviously, we don't even have to talk about, the growth number, the fantastic growth number that SoFi had, 2.5 million members. Yeah, a lot of members in the millennial generation with student loans. So they come up with their student loan, come in with their student loans or through the money account, and then basically start investing or doing other things. So this is why it's such a great model, because you have that one app model where you had different acquisition costs to get people in. For a loan type product, you usually have higher acquisition costs. If you think about it, if you get a home loan or student loan, it takes you much more to take up that loan. It's not like, let me open up a bank account or let me get a credit card. For a home loan or student loan, you require much more, conviction from your side to actually enter that contract, and to enter that contract with this specific company. So what that triggers basically is if I get you cheaply for a money check account, and then once you're using it, you like it so much, you're very likely to just have it all in one place and just open up your student loan account as well with SoFi. So this is that trick of that one app, one and all app, which basically every fintech is trying to do at the moment. So yeah, what coming back to the press release. So there's obviously, we wanted to talk about also other things that are not so great, or basically that we have to watch out for. So as we mentioned, massive growth opportunity. So growth is fine. Massive margin expansion now because of that national bank charter approval, which is fantastic. So this is what we want to see, because ultimately we want to have that free cash flow. We want to have that great margin, because only then we can get a return on our investment. If they're making loss forever, or if they're making tiny margins, then whatever you're paying, whatever multiple of sales you're paying, which is at the moment, I think it's around 12%. Oh, yeah, 14 the price to sales ratio. That means that, it takes you forever to get that money back. But as soon as they're increasing their margin, we obviously get that money back way earlier. So yeah, basically twice. We only take half the time now. But what are the sort of negatives around SoFi stock? If I go back to the balance sheet, which I've looked up online, this is from the last quarter that they've released. So we see a lot of, obviously cash, loans, advances to customers, which is all fine. What really sticks out is, obviously we have that loans here. We've given out 4.8, but we have a debt which is not debt from the customers. The debt from the customers that they're taking is actually an asset for us. So this is money that we have, or SoFi has taken up externally before they're like a bank charter. So there's external debt that they have to pay back, which they pay interest on as well. So it's $2.8 billion, plus what we've just saw. We have another 750 million coming up. So if you think about that, that would be, around a $3.5 billion debt, which is definitely something you have to look out for, because you don't want to get into a difficult situation where the company is having difficulties to pay, and where just the interest expense and the loan amount gets too big. So this is something we want to look out for. But and obviously in terms of the other point would be the terms of valuation. I mean, a 14 price to sales ratio, as I mentioned, although we have now doubled up basically our margin potential, you could argue that it was already priced into a certain degree because there was an anticipation that that bank charter is coming. So a 14 price to sales ratio is not super cheap. It's not like, yeah, like a Hims and Hers where it's not as popular as SoFi and it has a, price to sales ratio of 2. Um, so this has a 14 already, which is fine as long as they're executing, as long as they're growing into that valuation. So as such, a 14 is bad. I mean, if this was an established business, a 14 would be quite bad because that means that it would take you a long time to get that money back because there's only limited growth. So there's no way to get that down. So the only way it comes down is if either the price comes down or the revenue goes up. And the revenue goes up, yeah, this is basically what you're buying into here. So you're buying into the fact it has to grow a lot. It has to grow significantly going forward in order to grow into that valuation and actually bring it down over time. So this is something to look out for. So we're saying that, although it looks like it's a crazy deal still, when you look at it from 1 year back, you also have to think about those macro environmental factors, right? So we still haven't had an interest rate increase yet. We still don't know the number. So we know that there's something coming, but we don't know the number. So if there is a surprise to the upside of the interest, like let's say they come out and say, well, actually we have to increase the interest rate by 1.5%, then stocks like SoFi are most likely to suffer because at the moment we're expecting some sort of 4 times 0.5% increase. So if stocks like, if the increase is going to be 2% or 1% up, I think that's a negative surprise for the market, which will push growth stocks like SoFi further down. So this is just something to watch out for, but I actually have a position in it, and I think microspace is around 14 and something dollars. So I think, last August, September, that's when I initiated my position. Since then I had this run up, where I trimmed a little bit, and then basically came down to be now break even again for me with plus some realized gains. So yeah, so if you buy into that now, you have to be aware that there's some macro trends that SoFi has no impact on whatsoever, even if management is executing revenue growth, it keeps going up. In the short or near term, there might be more pain to come for stocks like SoFi due to the interest rate increases that they are announcing. So you have to give an investment like SoFi time. Although they're 10 years old, they're still kind of in a very rapid growth phase. So stocks like this, I think you have to give it at least a 5-year time horizon when you invest in it. So don't expect any sort of double up within the next year, because anything could happen in the short term, really. But as we see, the management keeps executing. They kept their promises. They have the bank charter now. Margin is expanding. Revenue is still growing significantly. So it's definitely a really good growth story that I personally bought into. So it's up to you to decide and do your due diligence and see what you can do. But just be careful in the near term, as once that bank charter news disappears a little bit and the euphoria goes away, it might further drop down based on the interest rate news again. But yeah, I hope you found that video helpful today. Let me know in the comments. Let me know any other companies you want me to cover, and see you next time.